Welcome to Financial Anarchy. Who is really qualified to manage your money? First, we will set the stage for why high-earning W-2 families often hit an advice wall. Then, we will outline the specialized experts you actually need, rather than relying on generic online advice. Finally, we will walk through practical steps, decision flows, and red flags so you can assemble a surgical strike team that works for you. Here's the agenda. First, we'll define the advice wall. Next, we'll detail each specialist you need: a CPA or EA for tax strategy, an estate planning attorney for protection and transfer, and a fee-only fiduciary planner for holistic retirement mapping. Then, we'll cover how to vet providers, compare compensation models, walk through decision flows, answer quizzes, and finish with a clear action checklist. Before we begin, an important disclaimer. This content is educational only. It is not tax, legal, or investment advice. Your circumstances are unique, so you should consult licensed professionals who can review your specific details. Investing involves risk, including possible loss of principal. Let's establish the problem. Basic advice like maxing your 401k, HSA, and 529 plans is straightforward. However, as your income rises, you run into a wall of complexity. You face tax phase-outs, high-income bubbles, and nuanced Roth conversion opportunities. Moreover, you need to consider how to shield assets and ensure your estate passes efficiently. Consequently, generalized wikis and one-size-fits-all internet articles start to fail you right when mistakes become costly. This flowchart visualizes when to hire which professional. Starting from rising income and complexity, it splits into three distinct needs. For tax strategy, the decision points lead to hiring a CPA or EA for Roth conversion planning, backdoor Roth execution, AMT considerations, and phase-out navigation. For estate planning, it leads to an estate planning attorney for wills, trusts, powers of attorney, guardianship designations, and probate avoidance. For holistic retirement mapping, it leads to a fee-only fiduciary planner to design withdrawal sequencing, optimize asset location, and manage tax brackets over time. A warning branch highlights avoiding commission-based product sales. This decision map helps you engage the right expert for the right job. Now let's reframe your team as a surgical strike unit. First, you have tax strategy handled by a CPA or EA. They are your experts for Roth maneuvers, phase-outs, and managing high-income tax bubbles. Second, estate planning is the domain of an attorney who drafts wills, trusts, powers of attorney, and guardianship documents, helping you avoid probate. Third, a fee-only fiduciary planner designs retirement income sequencing across taxable, tax-deferred, and tax-free accounts to minimize lifetime taxes. Finally, oversight means insisting on fiduciary duty and fee-only compensation in writing to ensure alignment with your interests. Let's zoom into tax strategy. A CPA or EA is a tax law expert, not an investment manager. They help plan, execute, and document backdoor and mega backdoor Roth strategies. They also navigate phase-outs affecting child tax credits, IRA deductibility, and education credits. Additionally, they watch for AMT, the net investment income tax, and the additional Medicare tax, modeling thresholds before December 31st. Ask for concrete deliverables, such as a written plan, safe harbor estimates, and multiple tax projection scenarios. Here is how to vet and use a CPA or EA. First, request a proactive tax plan with scenarios and timelines. Second, confirm they are comfortable with backdoor and mega backdoor Roth mechanics. Third, ask how they model phase-outs and handle estimated payments. Fourth, verify their e-file credentials and representation rights before the IRS. Finally, get fees in writing as flat or hourly, and avoid contingency percentages on refunds. Turning to estate planning, the core documents include a will, a revocable trust, financial and medical powers of attorney, HIPAA releases, and guardianship designations. Asset titling is critical. Deeds, accounts, and beneficiary designations must align with the documents. Trusts can be revocable or irrevocable, and may include special needs or spendthrift protections. Since probate can be slow, public, and costly, your attorney can design strategies to avoid it when appropriate. Review documents after major life events, or at least every 3 to 5 years. To fast-track estate planning, first inventory your assets and current beneficiaries. Next, choose guardians for minor children and successor trustees for trusts. Then, engage a licensed attorney to draft your core documents. After drafting, align account titling and beneficiary designations to match the plans. Store original documents securely and share access instructions with trusted parties. Finally, set calendar reminders to review afterlife events and at least every 3 to 5 years. A fee-only fiduciary planner focuses on mapping the order and timing of withdrawals across taxable, tax-deferred, and tax-free accounts. They manage tax brackets intentionally, sometimes filling lower brackets today to reduce lifetime taxes. Asset location helps place tax-inefficient holdings in tax-deferred accounts and tax-efficient holdings in taxable accounts. To mitigate sequence of returns risk, they often build cash buffers and apply flexible spending rules. Compensation should be fee-only and fiduciary, documented in the engagement letter. This timeline outlines retirement income milestones. In the early 50s, you consider catch-up contributions and potential Roth conversions. At age 59.5, penalty-free withdrawals become available. In the early 60s, you may pursue partial Roth conversions while monitoring Affordable Care Act subsidy thresholds. At 65, Medicare enrollment begins, and you should monitor income-related monthly adjustment amount thresholds. Around 70 to 72, evaluate Social Security claiming versus delaying. At required minimum distribution age, coordinate mandated withdrawals with your broader tax plan. The annotations emphasize tax bracket management at each stage. Let's compare compensation models. Fee-only fiduciaries are paid hourly or by flat fee, owe you a fiduciary duty, and are product agnostic. Their costs are transparent and free from kickbacks, and their scope and deliverables are documented. In contrast, commission-based advisors are paid via product sales or percentages, typically adhere only to a suitability standard, and face incentives to sell rather than provide impartial advice. Their costs are often opaque and conflicted, and scopes can be vague or shifting. This contrast explains why you should demand fee-only and fiduciary commitments. This table summarizes each role. The CPA or EA focuses on tax law and filings and is hired for Roth conversion design, phase-out navigation, and alternative minimum tax checks. Red flags include no written plan and contingency fees on refunds. The estate planning attorney focuses on asset protection and transfer and is hired for wills, trusts, powers of attorney, and guardianship planning. Be wary of one-size-fits-all templates and a lack of guidance on retitling. The fee-only planner handles retirement mapping, designing withdrawal sequencing, and asset location. Avoid any planner who sells commission products or refuses to provide a fiduciary pledge. This pie chart illustrates where costs can hide in conflicted arrangements. Fund expense ratios might consume a large slice, followed by assets under management advisory fees. Insurance or annuity commissions add another portion, along with trading and ticket charges, plus miscellaneous wrap fees. The caption reminds you that fee-only flat or hourly planners avoid commission structures, reducing conflicts of interest. Quiz time. Which professional is best to design and document a backdoor Roth strategy? Option A is a commission-based financial advisor. Option B is an estate planning attorney. Option C is a CPA or an enrolled agent. Option D is a fee-only fiduciary planner. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C, a CPA, or an enrolled agent. They are the appropriate tax law specialists for planning and documenting backdoor and mega backdoor Roth strategies. Second quiz. Which compensation model most clearly aligns advisor incentives with your interests? Option A is commission-based sales. Option B is fee-only, fiduciary, hourly, or flat fee. Option C is revenue sharing with product providers. Option D is 12B-1 marketing fees. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is B. Fee-only and fiduciary compensation structures reduce conflicts and create a legal obligation to put your interests first. Use this checklist to vet providers and keep your plan on track. Ensure fiduciary duty is in writing and confirm fee-only compensation. Demand a written plan with clear deliverables. Ask for modeling of tax brackets, phase-outs, and IRMAA thresholds. Align asset titling and beneficiary designations with your documents. Schedule annual or event-driven reviews. Finally, verify credentials. a CPA or EA for tax strategy, a licensed estate attorney for legal documents, and a fiduciary planner, often a CFP professional, for retirement mapping. Let's ground this with scenarios. In scenario A, your income jumps and you cross a phase-out threshold. You should call a CPA or EA to plan Roth conversions and adjust estimated payments. In scenario B, you have a new child and bought a home. Engage an estate attorney for a will, trust, and guardianship, and then update titling and beneficiaries. In scenario C, you are 5 years from retirement. Hire a fee-only fiduciary planner to design withdrawal sequencing and asset location, including building a cash buffer. Here are the key points. Avoid free financial plans that are tied to product sales. Get the fiduciary pledge in the engagement letter. Insist on transparent written fees, demand modeling for phase-outs, income-related monthly adjustment amounts, and required minimum distributions. Review estate documents and asset titling after significant life events. This mind map centers on the wealth team. The tax strategy branch includes CPA and EA roles for Roth conversions and phase-out management. The estate planning branch includes wills, trusts, powers of attorney, and guardianship. The retirement mapping branch covers a fee-only fiduciary's role in withdrawal order, asset location, and cash buffers. The oversight branch highlights fiduciary duty, flat or hourly fees, and avoiding commissions. This gives a compact visual of your surgical strike team. To summarize, recognize when rising income creates complexity that demands specialists. Hire the right person for the right job. A CPA or EA for tax strategy, an estate planning attorney for protection and transfer, and a fee-only fiduciary planner for holistic retirement mapping. Avoid commission-based sales models and demand fiduciary and fee-only terms. Get your plans in writing with clear deliverables and review documents and asset titling after life events. Thanks for watching. If this video helped you understand who is truly qualified to manage your money, please like, share, and subscribe. Finally, share your questions and experiences in the comments so we can help you assemble the right team for your situation.